Being a successful investor has less to do with a person's IQ, which is how intelligent one is, and more to do with a person's EQ, which is how is his emotional intelligence. A person that has emotional reaction to everything that is said to him cannot control his emotions and thus can never control his money. I did not say that. That was actually said by Warren Buffett. Successful and rational investing is part valuing and understanding a business and part channelizing your emotions of greed and fear. All the great investors you knew today understood their behavior and themselves much more than they understood the business. Businesses in general are a fragile framework and are susceptible to many changes, primarily due to various factors such as management, economic environment, policies of the government, etc. Most of these things are not in control of an investor, but what surely is in control of an investor is his behavior. In this book, we will learn how our behavior and emotions affect our investment decisions and how can we work around them to emerge out successful. This is The Better Investor, helping you achieve your financial goals and freedom through organizing your finance, stock market investing, and learning from billionaires. And these are top 5 lessons from the book Value Investing and Behavioral Finance by Parag Parikh. Lesson number 1. The Law of Farm. There are certain universal principles in life which don't change. Even if people change, times change, technology change, geography changes. There is one thing like the law of the farm. You cannot sow something today and reap tomorrow. Every seed which is sown will have to go through different seasons. It will take time before the seed becomes a fully grown tree. Same is true for businesses and investments. You cannot buy a stock today and expect it to double your money the next day. Success in life and investing comes in understanding that there are no shortcuts. In spite of that, we keep checking the price of our stock daily, giving us emotional dopamine. If the price is up by 10% in one day, we become happy. When it goes down by 5%, the next day we feel bad, not understanding that the fluctuation of the price is immaterial for a long-term investor. What matters to him is the price he has got at the end of his investment horizon. Amazon scored its first profit after 4.5 years after going public. Just because Amazon did not make profit in the first year, Jeff Bezos did not sell off his company and run away. He knew sooner or later his investment and hard work would show up in the operations of business. A farmer does not sell off his farms and liquidate his money if he has a couple of hot and humid months. He waits for the seasons patiently. Sometimes he may have to wait a little longer in case of bad monsoons, but he sticks with it and water it. But don't get me wrong, this does not mean to keep holding your stock even after you know that you have made a bad investment. According to the law of farm, it is pointless for a farmer to expect to have apple and strawberries in Africa or Sahara Desert. No matter for how much time he waits, farmer can never grow them there. So just like farming, in investing too, picking up the right seed and sowing it at the right time is important. Once the right stock has been picked up, all you need to do is wait and give it its time to grow and not come on to premature conclusion just looking at the price or hearing about a stock from the person around you. We can learn something similar from a famous value investor named Guy Spier. Every stock that he buys, he disciplines himself to buy for at least 3 years. Any stock that he feels is not worthy enough for a 3-year holding comfort, he does not buy them. This discipline allows him to stick with his winners and not sell them early just because they appreciated in price quickly in the first 2 months. This also allows his stock investments to get enough time for his situations to fan out. Once after waiting for 3 years, the value of the stock is not appreciated. He digs deeper to find out if there is anything wrong with his decision. This makes him have a long-term outlook and not get excited or sad because of short-term fluctuations. 3 years is just his time frame. It could be different for you, but the whole point is to discipline yourself to not get an emotional reaction from everyday price fluctuations. Lesson number 2. Good business versus good investment. One of the most common myth and jargon amongst investors is that the path to create wealth is to buy good quality businesses and hold them for long term. This statement misses a very important factor, and that is price. Whether or not a business will be good investment depends on what price is the business available for. There are many examples to prove that investors have lost money investing in quality businesses because they were bought at an expensive price. Let us understand this with an example. Castrol is a great brand of oil lubricants. Who does not know them? Sponsoring many Formula 1 MotoGP races, tying up with great celebrities to be the brand ambassadors, and a long experience. Castrol is nothing but a very high quality business. In the end of year 2014, it had posted its return on capital employed as 114%, which is phenomenal for any company. A return on capital employed of 114% means company was doing the business in a way that by investing a total of 100 rupees, say by buying assets, other companies, land, machinery, etc., the company was able to generate 114 rupees in earnings. And mind you, this was not just one of a case. Since 2009, Castrol was reporting return on capital employed of more than 100%. To give you a comparison, even the most successful companies today, such as Amazon, Netflix, Facebook, and Google, have return on capital employed close to 17 to 22%. Return on capital employed more than 20% is considered exceptional. So you can understand what a return on capital employed of more than 100% would mean. There was no debt on the balance sheet of the company. The earnings were growing every year. Castrol was darling of stock market and it was said to be the best stock to be in and the most safest one. Just like people tell you to buy Unilever or Amazon today. Another company in the same space was Tide Water Oil, which many of us know today by the brand Vidol in lubricant space. Its return on capital employed in 2014 was 28% and had been between 20 to 25% in the past 5 years. Let us see what these two stocks have done to their investors. Currently, the return on capital employed of Castrol is still more than 50% consistently, which is almost in top 5% of the listed businesses. That of the Tide Water Oil has been just 23%, much like before. Stock price of Castrol in the end of December 2014 was 245 rupees and that of Tide Water Oil was 4,501 rupees. Today, the stock price of Castrol after more than 6 years is rupees 140, a negative return of minus 42%. Stock price of Tide Water Oil is 16,425 rupees, a return of 264%. To make you understand in absolute terms, $1,000 invested in Castrol would be $580 today, and $1,000 invested in Tide Water Oil would be $3,640 today. But why did this happen? A market leader of such high quality, one of the most efficient businesses of the country, and still you would have lost almost half of your money investing with it. And here is the other business, not so much heard of, giving such outsized returns. The answer lies in paying a higher price for the high quality business while investing in Castrol. In December 2014, the price to earnings ratio of Castrol was 52 times. Whereas that of Tide Water Oil was just 20 times. People investing in Castrol at 52 times price to earning ratio were paying much higher price than that they were paying for Tide Water Oil. People buying Castrol were buying a business producing $1 in profit every year for $52, whereas the people buying Tide Water Oil were buying a business that produced $1 profit every year at $20. You were definitely getting more for the money you paid in Tide Water Oil than in Castrol. Also, Tide Water Oil just maintained its mediocre performance, whereas Castrol return on capital employed slowly decreased from north of 100% to 50%. Thus, great businesses may be a bad investment if not bought at the right price and right valuation. And an average business may prove out to be a good investment if bought at the right price. Today, the price to earning of Castrol is just 20 and that of Tide Water Oil is 40, even when the Tide Water Oil's return on capital employed is much lesser than Castrol. So what do you say? Are people again doing the same mistake with Tide Water Oil what they did with Castrol around 6.5 years back? Well, Time will tell us that. But remember, as a value investor, don't be blinded by someone telling you that so and so company is of exceptional quality. Quality is of only value to a value investor if it is offered at the right price. Lesson number 3. The recency bias. The financial memory of investors is very short. People always extrapolate things that happened recently into the future and form their opinions. If the stock market gives returns of 20% consecutively for 3 years, then people extrapolate this in the future and will put more money in stock market thinking the same will continue. Investors in Castrol extrapolated that it will continue to earn same return on capital employed just because it has done so in the past. In the last 5 years from 2015 to 20, the FMCG stocks performed really well, almost the big ones giving return of more than 20 to 25% every year. These performance attracted more and more fund managers and investors, whereas the commodity stocks such as that of cements, sugars, automobiles gave negative returns in these 5 years. People extrapolated the same performance in future and see what happens. From 2020 to 21, in last 1.5 years, the FMCG stocks have given almost zero returns, whereas these commodity stocks have tripled and quadrupled the money of the investors. So when something happens for too long, be skeptical to accept it as a trend and that it will go on forever. More often than not, it will not continue forever. Things revert to mean. To cope with recency bias, never extrapolate present performance into the future. Be conservative in your estimations. If in a coin flip you get heads 2 times consecutively, does that mean you will get it continuously for the next 10 flips too? Remember that. Don't extrapolate. Lesson number 4. Fundamental and speculative return. In investing, we are told that the stock price is a function of the earnings that the company makes. However, this is incomplete information. The returns that an investor gets from a stock constitutes of fundamental returns, which is how much the profit of the company has grown, and second, the speculative return, which means what is the perception of the people involved in the market about the company. Though this is a very subjective thing, however, the price to earning ratio is a good symbol of indicating market's confidence in the stock price. Higher the price to earning ratio at which the stock is quoting at, more optimistic are market participants about the company, and more expensive the stock is said to be. The fact that the people are buying the stock being so expensive proves the fact that people are ready to pay high price for owning such businesses. Like increase in profits is the fundamental return, similarly, change in the price to earnings ratio is a speculative return. Not always, but more or less price to earning ratio with respect to a competitor means that the stock price is undervalued. If you are thinking what rocket science I am talking about, you must go and check out my last video on the little book of valuation. The reason that the price to earning ratio of a stock has increased signifies that the people are buying it, even the price of the stock has increased much more in comparison to its earnings. Let's go back to our example of Castrol and Tide Water Oil. In 2014, the profit of the company was 475 crores and in 2021, it was 701 crores, an increase of 6% per annum. These of Tide Water Oil grew from 65 crores in 2014 to 141 crores in 2021, an increase of 11% per annum. However, the PE ratio of Castrol was 52 in 2014 and is 20 in 2021, a decrease of minus 14% per annum. The PE ratio of Tide Water Oil was 23 in 2014 and is 41 in 2021, an increase of 9% per annum. So the total returns in Castrol becomes 6% minus 11%, that is minus 5% per annum, and that of Tide Water Oil becomes 11% plus 9%, that is 20% per annum. So it is very clear that the speculative returns, which depends on the confidence or psychology of investors or market participants about a business, plays a big role in generating return on a stock selection. Rise in profit is not enough to guarantee a growth of your money in a stock investment. Thus, buying in negative environment is one of the processes followed by many value investors. During pessimistic times, the valuations are cheap. Stocks are available at lower PE ratios. When the market outlook becomes better, not only the earnings rise, giving us fundamental returns, but the psychology of investors towards a particular industry also becomes positive, making that stock sell at a higher PE ratio and higher price. Lesson number 5. The IPO phenomena. IPOs are known as shortcut to riches, the secret sauce to get rich overnight, especially when the markets are at all-time highs and it seems that nothing can go bad. Companies come out with IPO. These IPOs are marketed very intelligently and retail investors are sold a dream to make a quick buck, to invest in future, invest in next generation businesses. The herd mentality comes into play and these IPOs are oversubscribed by more than 20 times. The recent IPO of Zomato was oversubscribed by 44 times by the investors. This mismatch of demand and supply makes the stock list on the stock market at a very high price. Not only that, some people who do not get allotment in the IPO buy the stock the very first day the stock gets listed, shooting the price even higher. This looks so exciting, but as a value investor, we must understand that most of the IPOs give negative returns to the investors in long run. To understand why, we must know the phenomena of an IPO. Why does a company need to come with an IPO, which is called the initial public offering, that is listing its stock on the exchange? There can be many reasons: to raise money, to return the debt, or to raise fund to expand the business. But other than these, the biggest reason why companies come out with an IPO in bull market is because the promoters of the company or the initial investors of the company want to sell their stock at high price. When a company which is not listed in stock market wants money, they approach private investors and angel investors who take risk and invest their money with them. Now, when these people want to sell their stock of the company comes out with an IPO to allow these investors to exit. They want to sell their share of the company at the highest price possible. For this reason, most of these IPOs comes in bull market, when the stock market is just hitting new highs, when everyone is optimistic, when there is euphoria among people, when people are okay buying at high valuation. You will hardly listen to any noble value investor investing in the IPO. It is because they know that the IPOs are overpriced and overvalued. The people who are attracted towards IPOs are punters who form the part of the herd who want to grab a piece of the pie and get rich quick. Yes, there are businesses and managements that genuinely come out with offering to pay debt and expand businesses of the likes of DMart, Infosys, etc. If the sole reason for the IPO would have been genuinely raising money and expanding, then IPOs would come in bear market and in bad economic times when the money is actually needed and is scarce. The fact that these come in the time when herd mentality, speculation and optimism is at its peak, this only proves the point that promoters and initial investors use it as a vehicle to cash out big from the company, taking advantage of the poor knowledge of retail investors. Not only that, investing in IPO can prove to be risky too, since there is not much history of the company available about its corporate governance and relationship with shareholders. A value investor stays away from the herd mentality and rampant speculation. If you remember the law of the farm, you would stay away from such investment vehicles and get rich quick schemes. Let's have a quick recap. Law of the farm states that you cannot sow something today and reap tomorrow. It takes time for a seed to grow in a fully grown tree. Same is the case with value investing. Short-term price fluctuations, quick gains, and fast losses must have no effect on a value investor. It takes time for an investment decision to play out. A good business may not always be a good investment if the price paid for it is high. Be skeptical of people telling you that XYZ is a good quality business and will only go up. The most important factor for a value investor is value that one gets for the price one pays. The financial memory of investors is very short. People always extrapolate things that happened recently into the future and form their opinions. To avoid this, be conservative in your estimates and expect reversion to mean. The growth in the stock price is both the function of growth in the earnings as well as change in the investor psychology regarding a business or industry. Though subjective, but most of the times, PE ratio is a good indicator of this. Be skeptical of buying stocks about which everyone is so optimistic about and the stock is already priced to perfection. The companies need to come out with its IPO to raise money to pay off debt or to expand the business, though very few companies genuinely list the shares for this reason and most to take advantage of rampant speculation of herd behavior during bull market. Value investors most of the time stay away from the herd behavior. That's it guys. I hope you liked the video. If you did, do like, share and subscribe. You can check out my last video on the summary of the Little Book of Valuation. I will come again soon with summary of some other investing book. Until then, cheers guys.